Hi everyone, I'm Russell Muldoon from Montgomery Investment Management and welcome to this week's video insight. Well, according to a number of third-party broker research reports we've seen recently, a very buoyant period for the market can be explained away as being due to the optimism generated on the back of a reporting season which apparently was much better than expected. Now, having said this, those reports are usually biased towards generating brokerage activity, and after digging a little bit deeper by the investment team here, we can see discrepancy in the market appearing between those who experience quality growth versus those who are not. Whilst overall, the aggregate level of earnings growth for the market picked up to 14.9% recently when compared to the same period last year, clearly an impressive number, we think it's a far cry from shouting from the rooftop that a long-awaited earnings recovery has arrived. Now, there's a clear reason for this. The headline number somewhat hides the fact that a large percentage of this growth, and hence the market's optimism, was due to the large miners in BHP and Rio Tinto who've embarked on large cost-cutting drives. For them, profitability was forged not on top-line expansion, but on business efficiency. And if we exclude resources from this growth story, the story does look indeed very different. The same earnings measure comes down to a more modest 7.3%, still above the prior period, but again, this is distorted given the large weights of the banks and financials in the index, which we haven't yet considered. Like our big miners, banks did report well, and their improved results were again largely not due to top-line growth, but to lower impairments for bad and doubtful debts, i.e. lower expenses. Now, if we include these with the resources from our calculations, given cost-cutting is not infinitely unsustainable, the story looks even more modest with the growth rate falling to 3.5%, barely above inflation. There is a bright spot, however. If we just focus on industrial businesses, which are the core area of our investable universe, and a large portion of the market by number of opportunities, then this is where we believe we saw the long-awaited earnings recovery. In aggregate, if we exclude resources and financials and the poor showings of businesses such as QBE and airlines such as Qantas, earnings growth for this part of the market accelerated to 10%. This we find very encouraging, and as we have written numerous times in the blog, there are a number of standout performers that are growing not only their bottom line, but also their top line, which we would argue represents higher quality outcomes for investors. The likes of Seek, Car Sales, Ramsay Healthcare, CSL, Challenger and Certex, for example, all of whom we believe have strong business models and market positions, can continue to deliver higher than aggregate earnings growth, positive outlooks and positive earnings guidance. All of these factors have driven share prices in aggregate across our portfolios up, and in some cases materially so. And this brings me to an important point. In investing, games are won by players who focus on the playing field, not by those who are glued to the scoreboard. And so while others are racing around currently focused on a possible correction gathering pace at the moment, likely to be driven by the overvaluation in both US and Australian technology stocks, as always, the team here at Montgomery continues to focus on what we believe matters. That is, a focus on a select number of key individual businesses, their key fundamentals, and those fundamentals we believe are responsible for higher incremental investment opportunities and hence earnings growth in the future. And with almost 30% of our portfolios held in the safety of cash, and with just a handful of ideas being generated at present, we eagerly wait for better prices to throw up a number of new investment opportunities for us. Well, that's all for me this week. Please remember to follow us on Facebook and Twitter, and I look forward to seeing you next time.